Good morning and welcome to the ELECO Public Limited Company Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Jonathan Hunter, CEO. Good morning to you, sir.
Good morning, Alessandro, and good morning, ladies and gentlemen, and welcome to ELECO's 2023 interim results presentation. It's good to see you all today. Thank you for joining us. My name is Jonathan Hunter. I'm the Chief Executive of ELECO, and I'm joined by Neil Pritchard, who's the Chief Financial Officer of ELECO.
Good morning.
So for those who are new to the story, just a little bit of background about ELECO. It's a leading provider of innovative and award-winning solutions for the built environment. We develop all of our software solutions in-house, and therefore all of the IP is our own, which we're very proud of. Our core markets are in the UK, Scandinavia, Germany, Netherlands, and the US, where we have 267 colleagues. And we're well established in the core markets listed on the bottom right. And despite these strong positions, we continue to see significant growth opportunities as our customers expand their use of technology and they digitize their business. Some key takeaways to summarize the first half of 2023. We delivered on our commitment to transform the business, which is proving to deliver high recurring revenue. Our M&A search has been focused, and we completed an acquisition in the period. We've also increased our dividend, which at the interim, which demonstrates long-term confidence in providing ongoing value to shareholders. The financial highlights demonstrate record high growth in annualized recurring revenue and total recurring revenue. We're actually slightly ahead of our expectations internally, as we indicated this period to be at the low point of our SaaS transition. It's important to highlight for those that are new to the story that we embarked on transitioning the business model from a one-off perpetual license model to a SaaS recurring revenue model, and we embarked on that 18 months ago. So this is due to the way that revenues are recognized, you see a temporary drop in revenues and profit. But despite that, we remained just slightly above in the low point of the U on our financial journey. The total revenues were £3.5 million, which is slightly ahead of last year, and that's despite the inflationary pressures and so forth that we've been facing. The organic growth rate listed there as 5%, removes discontinued products, including an Archon business, which is a non-core architectural CAD business that we divested in the period. As mentioned earlier, the SaaS transition has an temporary impact on profits, but despite this, we remain profitable through the SaaS transition, and EBITDA and EPS were marginally down versus prior year, and that's of course again despite inflationary pressures. And many shareholders will be pleased to see that we've progressively increased our dividend. To provide more colour on our operational highlights and strategic progress, we continue to make solid progress on our strategy. We continue to transform the business while navigating through difficult times. In terms of innovation, one of the three pillars of our strategy, we're focused on our roadmaps. We had a heavy focus in terms of reaching out to customers and identifying future needs and requirements, and that has fueled our M&A search and also opened up our thinking towards partnerships, essentially to help our customers through their digital transformation journey. Some of the strategic partnerships that we were proud to announce in the period was one with the CTech Club, which exposes us to over 380 founders and CEOs of construction tech startups and early stage companies. And 2 weeks ago, we announced the partnership with a company called Nodes and Links, and that will bring AI to our planning customer base. Nodes and Links actually was identified through a review and discussion of 6 other similar technologies, and they came ahead in terms of their AI abilities. So we chose to partner with them. The second pillar to our strategy is to strengthen the business and ensure that we have a solid foundation for growth. And through the period, we continued to, we carried out a sales enablement program, which continues, rather. We trained all sales colleagues across all regions within the group with our own sales methodologies. And that sales enablement program continues throughout the second half and into next year by training and training other customer-facing colleagues in customer success roles. Customer success is key for the business. Being a SaaS recurring revenue business, our retention rates is important, and also our ability to upsell to existing customers. During the period, we welcomed some new colleagues in the leadership team, a head of innovation who brings 30 years of experience from the customer into the organisation and also understands our competitors and the technology within the industry. We also welcomed a head of UK within the business, who brings the experience he brings is leadership experience from the largest Autodesk reseller in the UK. He's gone through the SaaS transition with Autodesk and, of course, very focused on customer success, being a reseller and implementing services and price increases and so forth. He's also, post that business, which was acquired, had experience with mergers, which is very encouraging, given that we're merging a business that we acquired in the UK. Important for us as well is ESG, which we've made solid progress on, carried out a materiality review, which will input into our net zero roadmap, continued to receive the Great Place to Work certification, just demonstrating the strength in our culture and our people's belief in the strategy and management. And also very proud to say that we've received the ISO 27001 certification in the UK, and that's really important because it relates to data security and data privacy. The third pillar of our growth strategy is growth. And we delivered organic growth, and in particular recurring revenue growth, and that's been the focus of the strategy, is really building that recurring revenue, which now accounts for 72% of our total revenues. We accelerated our US SaaS transition with a hard push from April following our user conference. And we've also entered the US market with a direct-to-customer sales capacity in the period, and that's proving to be showing very positive signs with some new customers joining our accounts. And also that's given us the confidence to recruit further resources in the US. Our go-to-market is key to our growth strategy. It's important that the world knows and our customers know the capabilities that we have. So sales enablement was one part of our go-to-market strategy. We've been also focusing on other areas such as marketing and value proposition and so forth in the portfolio. Most of you might be familiar to what we do and some of our solutions. Just as a reminder, our product lines are divided into 2 groups in ELECO. There's the Building Lifecycle group, which incorporates Best Outcome, the newly acquired technology and business. Aster Power Project, which is planning and scheduling. BidCon, which is construction cost estimation. Shire Systems for maintenance and management, and Icon Systems for specifications and property and data management. Within this group, we label this as ELECO Soft. And then on the right, you'll see the visualization and CAD solutions. And these are very niche in nature, ranging from interior surface marketing and data applications with views, So that's allowing consumers to manipulate room scenes and make flooring and interior design choices. We have a staircase manufacturing, design and manufacturing solution, StatCon and framing, which are timber engineering solutions. Within our strategy, it's important to highlight that the core focus of our recurring revenue and our SaaS transition has been around the building lifecycle products, which account for 69% of the total revenues. With that, I will invite Neil to provide more colour and detail on the financials.
Thanks very much, Jonathan. That's great. Morning, everybody. Thank you very much for attending. So yes, I'm just going to take you through what, first of all, are some headlines, and then we'll go through progressively more detail on recurring revenues, the P&L, a little bit more on revenue splits, cash flow and balance sheet. But these essentially are the main headlines in the top bubble, if you like, revenue related. And what we've actually been doing last year end, we increased the metrics to cover ARR, and this time we're also introducing organic underlying, which I'll come on to explain a little bit more. Just to give a little bit more clarity, we are working on further elements in terms of metrics for the future, all relating to the SaaS transition. So you can see on the top that we have very high, as Jonathan's mentioned already, the higher recurring revenues that we were obviously is one of the key elements of sustainability and predictability for the future for both the business and for investors. And you can see in the 6-month period to the end of June that actually they moved up by 18% on both metrics, main metrics. And that basically takes the whole group up from 61% to 72% of total revenues being recurring, which is really, really good news. And that actually effectively provides an underpin and a surety around revenues, given low churn rates and high retention rates within the group, for future revenues and obviously future forecasts as well. If what we have done, as I say, with the organic revenues is strip out some one-time effects that were, if you like, within H1 22, the comparative 6-month period, and indeed anything that within the 23 on two particular areas, one of which is a group of several. First of all, in the first half, we did dispose of a non-core business, Archon, a German architectural CAD business, and that obviously revenues from that have been stripped out for the future in terms of the organics. Secondly, we end-of-lifed 2 internal products, and which were situated within Sweden and Scandinavia. And also there was 1 external product for which we act as a reseller within Sweden and Scandinavia that was end-of-lifed by the external party. So taking all those into account, those would have contributed between 900 to another million of revenue. So you can see that actually stripping that out is really quite a, we were ahead anyway of our own expectations, but even with those, we would have been even further ahead, if you like, in the headline numbers. So if you even look at the overall revenues being slightly ahead, if you then strip out currency, we were further ahead, and then the organics even further ahead. So recurring revenue growth actually across the 6-month period was, stripping out those one-time effects, was actually around about 21%, and the exit rate, the last month of the period times by 12 annualized, was at 24%. So the underlying growth story it was really picking up as we were exiting the period as well. So that's fantastic. The second bubble below is around the overall revenues. The overall other metrics apart from the revenues, I beg your pardon. And as we have been subject to obviously the overall sort of inflationary pressures that all corporates have been experiencing on top of the SaaS transition. So actually, we're very pleased that they've come in better than anticipated on many of the profit measures that you can see there. And they actually held up very, very well. We did make an acquisition in the period with some one-off acquisition costs as well, which we'll come back to. So overall, net assets have moved ahead. That acquisition was with other duties and other related costs totaling around about net 3.8 million. So that 3.8 million has led to that 17% reduction in cash between between the halves. But actually, if you'd strip out again the acquisition, the cash would have been overall ahead by 17%. As many of you know, the group is very cash generative, high margins, and great quality of earnings as well. So that's really nice to see. And as Jonathan mentioned, also we are raising the interim dividend by 25%. That's on top of a 25% increase we did at the year end in the final dividend, and also a special dividend, which with regards to the disposal proceeds of that Archon German architectural business as well. So just to give you a little flavour, I think in terms of the the journey thus far, we actually announced towards the back end of the final quarter of 2021. The SaaS transition as part of the overall strategy, and as Jonathan mentioned, obviously it does tend to lead to less perpetual one-off upfront, all revenue recognition, all cash upfront vis-a-vis your cost base, to more of a subscription and SaaS recognizing revenue as you go along basis. And the group has been incredibly successful in doing that and not going backwards like other companies in doing that. But equally, going forward, we've actually moved probably from actually levels below 50%, frankly. But when it was announced in that first period, you can see there 55% through to where we now are at 72%. So that gives a flavour of the trajectory and the success of the SaaS transition. Moving on to just a little bit more detail, if I may, on the P&L. I'm not going to cover off the revenue-related ones that are within the slide deck, which you'll be able to look at your own, and many of which I've touched on. But in terms of the overall cost base, you can see the amortization slightly higher than in previous half. There were the one-offs of the share-based payments, the acquisition costs and stamp duties. Share-based payments broadly similar. Other admin expenses moved from 9.2 to 9.7 million, which was really around about a 5% increase. But for full transparency, there was a cost base relating to the disposed business of about 0.3. So the overall movement is around about 0.8 or just over 8% up. And that really is reflective of those increased inflationary environment that we saw, a continuation, if you like, into the period of, some of that war on talent and retention on talent we saw in 2022, and also some incremental increases in headcount as well, to meet business needs in a very evolutionary way. Overall, there's also a gain on disposal, which is the 150k gain on the disposal of Archon, and taxation is somewhat lower due to a different mix of lower German and Swedish profits for some of the reasons that I've outlined, and also more of an increase in deferred tax in the prior period relating to substantially enacted rate, a hike in UK corporate deferred future corporation tax rates. If we then just move on to just a tiny bit more detail, if I may, on the revenue, what you see there are three charts. On the left-hand side, this is something that we introduced at the last year end as well to provide a little bit more sort of detail of what you can see. The left-hand side really talks about the types of license revenue. The centre really talks about the two core groups, if you like, that Jonathan mentioned earlier. And on the right hand side are split by geography. So on the left hand side, what you can see is obviously the lower perpetual licensing, which is natural as part of the SaaS transition. So that's moved down from 16% to 7% further to about 1 million. The higher recurring revenues that I've already spoken about, up to that 72% to 9.7 million. And then finally, services income, services and consultancy, but mainly around services and training. Now that was actually a little bit lower at 2.8 million against 3. And typically what we have seen, that's probably the one area where as a group, you know, if there may be some deferred or paused or training revenues that may be coming through in times of some macroeconomic headwinds that people are doing. So some pause projects around that, and also on the visualization side as well. In the centre, that really reflects the 69% that Jonathan mentioned earlier, which is around the building life cycle. So that is now a bigger part of the group. That has been the focus for the SaaS transition. Visualization and CAD does have some recurring revenue elements, mainly around maintenance and support, and also around some hosting and SaaS revenue as well. But nevertheless, that remains the focus of the group. And on the right hand side, what you can see there is the split by geography. Now you can see that actually the UK was ahead, despite the effects of the SaaS transition. The UK was further ahead in terms of embarking on the SaaS transition. Scandinavia and Germany are back, but they're back because in the case of Scandinavia, those 3 end-of-life products, they would have otherwise been ahead. Germany is back because of the German disposal. Had that not happened, Germany would have been ahead. Rest of Europe is showing some very nice growth as well, and as is indeed rest of the world in absolute numbers. Now USA, while level there in the first half, doesn't sort of belie the actual what's going on under the bonnet there. In particular, in the first half, the total numbers of logos and total contract wins and so forth have increased, and total absolute value of those sales in terms of ACVs. But the one thing that was notable in the first half was we moved the reseller customer network. We started that transition there on SaaS, so that's obviously slightly depressed the overall headline number, but as I say, underneath the bonnet, things are moving nicely in the US. So that's really just a flavour of some of the splits for you there. If I move just on to cash flow and cash, as I say, the business is traditionally very, as a SaaS focused software business, a very scalable business, has high margins and very cash generative. SaaS transition has an effect, but again, not as much as might otherwise have been expected. If you look on the waterfall chart on the right hand side for the actual reduction from the top left, what you can see, the 3 main drivers really are, first of all, the acquisition of Best Outcome, which we'll come back to, and that's the 3.8 I mentioned earlier. Secondly, a typical level of investment in D to maintain and enhance our product portfolio and solutions to the market for our world-class best-of-breed solutions. And then finally, actually, in the first half of this year, we actually paid out substantially more in dividends because of that increased final dividend and because of that special dividend that I mentioned earlier. So those are the main flows driving that overall outflow. We still remain very cash positive. We have no borrowings. We have access to that for financial firepower. And just a little bit on the left-hand side, the free cash flow as a proportion of our operating profit, the quality of that has improved in the period again. So really, really good news on all that score. We are obviously very mindful of all our investor base and both organic and inorganic needs, but we've had some very supportive shareholders with regard to the SaaS transition. We are cognizant in a tough market, even though we're much better performing AIM stock than most, of the need for some dividend income as well. Just finally moving on to the balance sheet, it wouldn't be normally something that you'd expect to move too much, but I think there has been quite a few just particular reasons for it, really. First of all, at the end of the 6-month period, we announced the acquisition of Best Outcome on the 23rd of June. At the end of June, we took in the values and the balances, if you like, for Best Outcome into the group balance sheet, which is what you see here. So there's some quite big movements in terms of goodwill and there are capitalized intangibles. And for those of you on the technical accounting front, those are kind of fair valued and group aligned policies, so around IFRS 3 and so forth. So what that means is those are provisional, they will move around. They'll move around subject to the sort of fluctuation of time, and that has things evidence within how they're incorporated within the group, but secondly also subject to audit at the end of the year. So they are very much provisional, so you may well see those move by the end of the year. Another reason why you will see some significant movements was Arcon, the business we divested in the first half, as well as the acquisition. The one we divested was really around the fact that that was held for sale, and so that was two groupings of an assets held for sale and liabilities held for sale. So you'll see that in the comparative H1 period, which obviously, having sold it, depart out of the end balance sheets at the end of the current interim period, if you like. So outside of that, otherwise things are moving ahead nicely, more in receivables, so forth. There have been a little bit upticks in terms of other things. Overall amortization broadly is equivalent to additions to the balance sheet. So again, very prudent capitalization and amortization policy for the group. And one of the very interesting measures, I think, which is again really insightful and positive for us, and I think a good indicator, although timings can vary between year ends and half years in terms of working capital flows and so forth, and timings of contracts, but overall deferred income is up by 32%. Now, if you actually strip out the million or so that we've brought in as a balance from best outcome, deferred income's grown by 18%. And at the year end, that was 10%. So again, the trajectory of the group is improving all the time, and really nice to see. Overall, increased by over $1 million on to the overall balance sheet as well. So increased balance sheet strength. And with that, I think that's probably all for me at this moment. So I'll hand back to Jonathan. Thank you very much.
Yeah, thank you, Neil. So within this part of the presentation, I'd like to provide some more information on our strategy, our customers, and also the best outcome acquisition and the progress we're making at the early stages. Creating certainty for the built environment is our vision, and we aim to do that through digital transformation. And our strategy is quite a simple one in that we continue to innovate and build world-class solutions. We deliver those through a very well-governed and responsible platform that we continue to strengthen with good culture, and it's designed. Our culture is designed to attract and retain talent, and ultimately grow the business to remain relevant and be able to implement and create that certainty for the built environment. So within the, looking into the future, we'll continue to enhance our product, strengthening our business platform. And when it comes to technology, we always consider whether we build it ourselves or we acquire or partner. So we're constantly monitoring what adds the most value to our business, our customers, and of course shareholders. The types of acquisitions that we've been seeking, we defined in the annual report and accounts. You'll see in my comment there, we have type A, B, and C. So type A is revenue and profit led, which complements our customers, and that's very much where best outcome fits. Type B is technology led, which can enhance our roadmap and accelerate our technology plans. Best outcome crosses over into a type B as well. And type C is next generation technology, which could be from another industry but could work within the built environment. We currently have an active list of M&A targets, and we continue to measure against our criteria. We also continue to focus and strengthen on the platform to ensure that it's profitable and continues to improve. And whilst we're doing that, we've turned our focus to growth and diversifying and broadening our customer focus but within the built environment. What we mean by that is offering the solutions within a wider audience within our customers, and moving outside a single individual within a department. Focus for the upcoming period is go-to-market activities, and we continue to incrementally roll that out, making further investments in H2. And we'll continue to always keep customer centricity at the core, and to achieve this, we're focused on customer success capabilities and ensuring that we understand and maintain those relationships with customers. And that's something that ELECO has done very well over the years. The products are best of breed because of the way that they've been developed through incremental discussion and iterations, which makes them very sticky and also very difficult to displace. And ideal as we've been going through a SaaS transition, we continue to experience very low churn. And as you're seeing with the results, the recurring revenue is growing, and that's providing confidence for the future. In terms of the built environment, there are key drivers within the sector that's driving the need for digitalization. It remains really exciting and buoyant. We still see growth within the sector, and long-term growth as companies adopt technology to meet some of these industry demands. There's ongoing pressures on costs and margins with material prices and labour rates fluctuating. We see new construction techniques with manufacturing for design and manufacturing for assembly on site. ESG and sustainability is very important and a driver in the sector, and also safety regulations and requirements, and new technology. As building projects are collecting more data, we're also seeing new technology applications. But what is key is that understanding of customers, and the built environment and projects, construction projects in particular, are very complicated, and it involves many different parties, and they're only becoming more and more complicated given these drivers. So whilst we see that the sector has traditionally been slow to adopt technology, the rates of technology adoption are increasing, whilst the complexity of projects is also increasing. So just an example of how our customers are using the software, and a customer case on our sales approach, where we will introduce a new customer and continue that relationship and expand. Kingspan is a customer who joined us in 2 years ago, and we've been working for 24 months to expand our maintenance and management solution across their portfolio of manufacturing business operations. For those who don't know, Kingspan is a global manufacturer of building products, and they have manufacturing locations across the world, and we've expanded into 6 countries, including Germany and also the US. With further opportunities to expand into Finland and Eastern Europe. Kingspan are very pleased with the solution. It allows them to manage their maintenance schedules, track their breakdowns and servicing, manage inventory, and also performance across multiple sites, so they can benchmark each factory and the production and maintenance performance. And they continue to be a fantastic customer in that they're beta testing some of our upcoming solutions that are going to be released early next year. An example of a US customer and innovation, Bartlett & Koch is a general contractor located, headquartered in San Antonio, but have 3 locations in Texas. And they made the decision to migrate to Asta Power Project, our planning and scheduling solution. They did that after a really comprehensive evaluation of the solutions available in the US. And what they really liked about Asta Power Project is that it's easy to adopt, but also we can provide a full enterprise portfolio management solution with on-site mobile tools and full best of breed suite. So they're very confident that the solution is future-proof and it can grow with their organization. So this example is really exciting because it demonstrates that not only is our solution the best of breed in Europe, Asta's won the best planning solution in the UK for the last 9 years in the construction sector, but also, we're holding our own in the US against the competition. So I'd like to provide an update on Best Outcome, and firstly start with a little bit of background about Best Outcome. It's the business we acquired towards the end of June. Best Outcome is a SaaS business, and it provides project and program management software. They're the only outcomes-focused solution that we know of in the market, and the code base, when we looked at it, is very well governed, very well developed, and it stands out amongst its peers due to the high security protocols and also its accessibility. So it can provide, the interface is designed for vision impaired, which is a significant investment for anyone that wants to come and compete within the public sector space. They're now the largest, the largest supplier of PPM software to the NHS because of that security and also accessibility functionality, as well as, of course, being very easy to use. Why does Best Outcome fit with ELECO? It certainly fits with our M&A criteria. It's a profitable SaaS business that's been growing and complements our existing customer base. We actually had a similar solution within the Asta portfolio 15 years ago, which we end-of-lifed at the time because due to constraints on the group as we were transitioning from a construction business to a software business. The solution is very well respected within the industry, and if we look at the complexities of construction and the way Best Outcomes workflow works, it's focused on outcomes, so objectives of a project, which makes it a top-down planning solution. It has Gantt chart capabilities within the software, and therefore that can be imported and exported within Asta Power Project, so therefore it's already compatible. But by contrast, Asta is a very detailed project planning solution for complex projects. So the way the workflow works is that every task is entered into Power Project, the dependencies and critical path is created, and then you can calculate your end date. So a bottom-up approach, whereas Best Outcome provides a top-down focused on outcomes and objectives. So a very nice fit for our portfolio, and also something that we can offer our non-construction audience in the Shire systems maintenance management and facilities management customer base, and also Icon Systems, where we have a strong retail customer base managing properties and projects relating to properties. Just to provide a little bit on the deal metrics and the integration, the consideration was by way of cash, and it was the initial consideration was £4.825 million, and within the business there was just under £1.3 million of cash in the business. Therefore, net consideration was £3.559 million. There is an earn-out of £500,000 to the sellers who remain in the business, and that earn-out is set on quite stretched targets. So it's not automatic, and it does ensure that the sellers and former directors are motivated to continue to grow and ensure that integration and the benefits of the merger are seen. The integration is progressing extremely well. We were very conscious that we've been developing an integration plan pre-completion, so we worked with the management and collaborated on what we aspired to do in our integration plan, and that has been carried into Best Outcomes software solution, and it's been managed by a dedicated program manager that was introduced by Best Outcome. And the purpose of that is to really hold everyone to account, ensure that the objectives are very clear and the outcomes are clear, and allows us to continue to search and identify further M&A opportunities. Just to add as well, I'm very encouraged by the directors that post due diligence have jumped straight back into the business, and they're focused on sales and marketing and go to market, and also taking advantage of the opportunities of the merger, and they're absolutely enjoying the experience and working with the ELECO colleagues, which is really encouraging. So that gives us more comfort in terms of looking at further opportunities for M&A. So in summary, I'll just change this. In summary, I'd just like to highlight the investment proposition for ELECO. We are a profitable, high recurring revenue business. 72% of revenue is recurring, and you can see the ARR gives us confidence and visibility of the future. We provide world-class software and technology. We have very strong customer relationships that we've grown over many years, and customers really are loyal to the products and the brand. We rank very highly on customer service. We had a customer satisfaction survey we carried out earlier this month, showed that our highest score was within customer service, just demonstrating the care we take for customers. We have large and growing markets. There's population growth, which is growing the demand for construction, but also the complexities of construction, and then managing green, efficient buildings is a real driver. So it's very exciting in terms of being a tech player in the market. All of our IP is proprietary and 100% owned by the company. We use very, very little open source, less than 5%. So we're very proud of that, and we scan and regularly check for open source to ensure that the software is well written and well governed. We have an attractive business model with high gross margins and recurring revenue, cash generation, proven time to market with our in-house R&D. We can release products, and also our relationship with customers allows us to test those products with customers before release. We're growing organically, which has been the focus, and of course, very important for us to scale. And we're executing against what we said we would in our strategy, so we're pleased to be on the right track there. A summary of the first half of 2023 is that we continue to have high recurring revenues. The quality of recurring revenues is very, very good, and should be appreciated. We're continuing to go, and we'll continue to do so in the second half. We've completed an acquisition. The M&A search continues. We also divested a non-core business, and we announced some partnerships as well. And I think that's key in terms of AI. It's moving so quickly in that whilst we have our AI roadmap and ambitions, it's important to also partner and not immediately invest or acquire, given the early stages of AI. And we're very proud to be increasing the dividend, which shows confidence in the future. So with that, that draws our presentation to an end, and I'll hand back to Alessandro to open the room up for questions.
Perfect. Jonathan and Neil, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, I've received a number of questions throughout today's presentation. And if I could just ask you to read out those questions and give responses where it's appropriate to do so, I'll pick up from you at the end.
Okay, thank you, Alessandro. So the first question was pre-submitted, and we may have answered this in the presentation, I expect, but the question is, can you discuss why German revenues have fallen? So perhaps, Neil, would you like to?
Yes, certainly. Yeah. So really, the absolute primary reason is around the disposal of the very German market-focused, German-based architectural CAD business for Archon that was disposed of and we announced in February. Of the sort of between 0.9 and 1 million or so, approximately half of that is actually related to that divestment. So you can see that without that, Germany in itself would have been ahead. Germany is slightly, always was a little bit further behind on the sort of SaaS transition than other markets as well, but nevertheless would have been ahead. So that's really the primary reason.
Thank you. I have a second question, another one for you, Neil, by David S.
Mm-hmm.
What can be done about the admin and selling costs for recurring revenue business that seems high as a percentage? How much incremental revenue can the current cost base take?
Really good question, actually, and I think that's sort of geared around sort of future growth and also around operational gearing, which we would certainly like to see more of. I think going back to first principles, what you find in software businesses and particularly SaaS software businesses is because you're no longer providing on-prem kit or whatever else you need. It's a very scalable business, first of all. And it's obviously you have that upfront investment in R&D, but thereafter it's very scalable in terms of the merits and the benefits of the revenues that derive from that going forward, and a substantial tail from that. So we are conscious. I think a couple of things I would say. I think we are conscious that our EBITDA margins in that sort of 20 to 25% range, we would like to get higher, and I think the future will afford that opportunity to do so. Not necessarily there in the forecast, but that's where we'd like to take it. In terms of the incremental revenues from the current cost base take now, we are, as I mentioned earlier, on the staff costs, incrementally adding people. There's been a huge amount of work done in the last year on go-to-market initiatives in many shapes and forms, and basically levels to enhance, particularly the sales and marketing front, because in a sense we have world-class products. It's just that actually, more people just need to know about us, really. So there's been a lot of work on both how that's done and the people who will do that work. We don't see a scale up needed within the cost base in terms of a step up till possibly later part of 2025 into 2026, and even then we want to return to those sort of our ambition is to move back to those sort of higher EBITDA margins as well. So we do think it's very scalable. We do think we're very conscious of it. We don't, we are very cost focused as well, and I think that comes from being a technology led company in the past. In terms of all that, you always have to be conscious of that, and I think there are some opportunities for the future.
Yeah, thank you. And I think just to add to that, also the transition to SaaS versus the perpetual license model. If we look back 2 years where we were selling licenses, we would have a sales force having to sell licenses, the same number of licenses each year to stand still, and to grow those licenses and grow the top, the license revenue, we would have to add more sales resource. Moving to the SaaS model where licenses are on a subscription basis, that certainly changes. Instead of in terms of the sales folks will sell the software license, and that becomes a subscription, and then we have account managers and customer success teams to ensure those customers renew, whereas sales teams focus on further acquisition of new customers or expansion within the existing customer base. So that certainly supports the sort of margins, and I guess just demonstrates, the strength and what it can bring. So thank you for that question, David. Next question is from Neil B. Do you anticipate do you anticipate an acceleration in revenue and profit growth to the end of the year? And yeah, absolutely. We've indicated that the first half would be the low point of our SaaS transition in terms of that financial journey. When we set out and announced the SaaS transition, we said there'd be an 18-month period. So as the revenue is recognised, it will dip like a U shape and then come up again. But also we've experienced inflationary pressures during the period, and we've invested in strengthening that growth platform. So we've been very mindful of managing the overheads, ensuring that every expense or every investment in the business is being stretched as we're going through this transition. That's why we're so pleased to remain profitable, and now we're through the worst of it. We've indicated that the full year of this year we will be ahead of last year, despite being in line at the end of the first half. So the answer to that is yes. Neil. And final question here, unless anyone else asks another one, it's from Colin C. Can we expect the dividend to continue to grow at the current levels? So perhaps Neil, you'd like to respond to that.
Yeah, it's a good question. I think there's a few things that I'd probably say. I mean, there was, in line with many other corporates, a pause that took place when the uncertainties of COVID hit back in 1920 and 21, and that obviously, and actually, by the way, the group weathered that storm very, very well in general, and repaid furlough elements and everything like that. Now, since then, dividend sort of was growing and continues to grow. We have stepped up at the last year end in that regard, also provided that special dividend. So that was a noticeably high level, obviously around a one-time disposal, but we wanted to signal that continues, in the sense that the interim as well. Every dividend decision in every listed company, every corporate for that matter, but every listed company is a collective board decision, and it takes into account both the situation you're in but also the future situation. So it's about the efficient deployment of funds. For example, if there was an M&A that required cash to do that, it's better to do that than, say, at current market levels, asking shareholders to fund that. So you can see there's always a trade-off involved in things between the organic and inorganic. Also, as another example, it could be that there's a particular R&D investment that we see, a particular opportunity over and above the rest, which might mean a step up, in particular in some of the programs that are run there. So it's difficult to say it's always going to be X% of this and whatever, because there's so many different metrics around it. But I think fundamentally the board is more cognizant of those, not just those competing demands now, but also as we emerge out of the SaaS transition, the ability to pay that. And we are very conscious of very supportive shareholders. We're very grateful for them. And in current markets, as I said earlier, it's very difficult. So I think where we want to go is for it to be progressive and sustainable, and therefore be attractive from both sides. Now, some institutions you talk to, frankly, just want to see capital growth and are not interested in income. Equally, at the other end of the spectrum, for the sophisticated professional investors, they're very, very, very interested in dividend income, and private client brokers and so forth, somewhere in the middle. So there's a whole range of people out there, and you do have to say, be aware of that, be aware of your shareholder base, be aware of your future shareholder base. But one of the things that I can say, without giving what those metrics are, we look at many metrics, and we say not just look at current, but we look at where we're going to end the year, where we're going to be ending in 2 years' time, and so forth, to understand what is the right payout there that is appropriate. And on M&A, clearly what's interesting there is obviously how compelling that is, how important that is for the types A, B, and C that Jonathan's outlined and articulated incredibly well on the strategy. So we're mindful of M&A, but also it has to be compelling and it has to add shareholder value. And so the total size of the cake increases in terms of the value of the company, and the growth prospects of the company.
Jonathan, Neil, thank you very much for that. I think you've actually managed to address all those questions from investors. And of course, the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Jonathan, could I just ask you for a few closing comments?
Yes, thank you. Thank you very much for all of your questions and your time today. We're very, very open to feedback, so please do if you take the time to respond and provide your thoughts. And we really hope to see you all again at the full year results. Thank you.
Thank you very much.
Jonathan, Neil, thank you once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team could better understand your views and expectations. This will only take a few moments to complete, but as mentioned, will be greatly valued by the company. On behalf of the management team of ELECO Public Limited Company, we'd like to thank you for attending today's presentation, and good morning to you all.